JJ, the CPA here. Hope you're doing well. I want to visit with you about how to structure your business if you are in the real estate business, whether commercial or residential or flipping. Now, I am going to walk through a schedule with you so that you can see here's what it is that I do directly with my clients. Now, at the end of this video, you'll have a link at the bottom left to walk you through how I take my clients to this point, which is how we structure them overall. But what I want to focus in on is the real estate here. So when we are talking about the real estate, for those of you that just want to see the end result, this is what I'm getting ready to go over. Having a master LLC that owns a number of sub LLCs to separate out the properties, not only for liability, but separating those out potentially for accounting purposes or 1031. This puts it all together to then have everything reported on one tax return that then flows down to the individual. So that's what I'm getting ready to go over with you. Now, I do have a longer video that I'm going to give you a link to that will be at the end of this at the top left, and that'll be a little longer version of this. But with this, we start with the individual, and they own then a partnership, and that's going to file a Form 1065. This is what we would call the master LLC. Then we would set up a sub LLC that would own each property. So for property one, we would set up an LLC, and with that, it would be considered a disregarded entity because it's going to be 100% owned by the partnership. Now, a disregarded entity doesn't mean that it's disregarded for any other purposes except for tax reporting, meaning it doesn't file a separate tax return. All the income, expenses, and depreciation would be simply reported on the master tax return, that Form 1065. Then if we're going to have another property bought, we would set up another LLC, and that would own that property. It would still be disregarded. We would do the same thing if there was a additional property for number three. Why would we do this? Well, the benefit here is that if we are in a set of circumstances where you own a property, well, if there is any kind of liability inside the master partnership, well, by it being in a separate LLC, that's going to protect that property from anything in the master LLC. Now, if something were to happen in property one, liability-wise, then it's going to be protected from any ownership or issues related to property number two or property number three. What this means is that if there's a lawsuit related to whatever LLC number one sub owns, well, then only those assets inside that LLC would be available for any kind of taking care of the liability that could come out of that. Same thing with 2 and 4, 3. Now, if you are going to get into flipping properties, typically with our clients, we would just have all the flipping activities in another LLC that would separate out those activities from then the ownership. So you could own a lot of different properties, have a lot of different LLCs, but what we want to ensure is that we are having each one of these LLCs owned 100% by the master LLC, because again, then the sub LLCs will be disregarded, meaning they don't have to file a separate tax return. Now, the income and the expenses, as well as the depreciation, is all going to be reported on that master LLC. Then there's going to be one tax return. This is where the ease comes in. There'll be one tax return that then is filed with the IRS. Now, it includes all of the activities of all of the sub LLCs. And then whatever that net income is, that's going to be then reported down at the individual level where that net income is then reported. So with that, this is kind of the structure that we go through with my clients. And when we're putting together kind of this structure, we would probably just start with the master LLC. And then as properties were added, we would just set up that additional LLC. Now, each LLC would have its own EIN. It could have its own separate bank account or not. Each of those sub LLCs basically allows there to be simplification of accounting, simplification of tax reporting, but then giving you every opportunity to separate things out for liability purposes. All right. So if you want to get the longer version, you're going to see that coming up probably right here. If you did want to see the video that I break down what I showed you at first, which is S Corp, partnership, and kind of the general structure overall for all kinds of businesses, then there should be a link to that video right here. And then I've got a playlist right here for you that would be for those that are small business and self-employed. And then I'd love it if you would subscribe. All right. Hey, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. Have a great one.